Good morning, everyone. Goeiemorgen, Sanbonani, Dimelang. Welcome to Smart Caps Learning Online. That is sponsored by VT. I welcome you to our accounting lesson, and I hope that it will benefit you. And I hope your morning is quite good. And we'll just do some few lessons, maybe one, two topics. Then we'll take it from there. So, that for you to participate, to be part of our lessons or our activities, any assessment, just go to www.hellosmart.com and sign up as a guest. And we've got a class ID number there, that is 598751. Go to www.hellosmart.com, sign up as a guest, and then just create a new name. And the class ID number is 59875. Yes, thanks. Okay, let's start. I want to redo something here from this question paper, just a few things. Yeah. Okay. There's something that I want us to redo before we go to our question today. There is a question here from this question is taken from a question. It's a question taken from 2016 question paper relating to the balance sheet. That is 4.2, question number 4.2. This one here. The question here yes, it's about the requirements to prepare a balance sheet, that is a statement of financial position on 29 February 2016. Show all calculations, show all workings. So we'll just do the workings and we'll see how we go about. So I'll just take it slow. I don't want to jump. I'll take it slow, step by step, even if we don't finish in this session, but we'll still continue so that you should understand. Okay, firstly, just to remind you, drawing up a balance sheet, okay, that's your statement of financial position. Okay, of financial position. Okay, now you first have to state first the name, just to recap on something, the name of the company, of the entity, then here it's a statement of financial position, the date as at the date or period. Okay, with that, and the other thing is Then you're gonna draw a line here to be like this. Then this is how it's gonna look like. Then if you start with your assets, remember that your statement of financial, that's where you find your equity and your liabilities. So start with your asset. Under your asset, you start with your non-current assets. Assets that you maybe your fixed asset or fixed asset or your property, plant and equipment. Property, plant and equipment. So just a recap. That's where you find maybe your fixed deposit. Fixed deposit. That's where you find your maybe your financial assets. See, on and on you could go. Then we've got also your, okay, let me just underline. Okay, then you got your current assets, your current assets, and that's how you get your inventories, cash and cash equivalent, cash and cash equivalent. And trade and other receivables. Okay. Then I've got what digital assets. That's how it goes. Then under your liabilities, we've got the second section is your equity and liabilities. Then share capital. No, sorry. Equity first. So we find your share capital. Remember we spoke about this, and your retained earnings. And your non-controlling interest. But I think this is not in your syllabus, so don't mind it. Never mind this one. I don't think it's in your syllabus. Then we've got your liabilities. That will be your non-current liability, and that will be maybe example a long-term loan, long-term loan, and then you get your current liabilities. That will be maybe your current portion, maybe let's say portion. Portion of long-term loan, then maybe your trade and other payables. Then your income tax. Okay, it was just a recap so that you should know how a balance sheet looks like. Okay, let's get to our question. Okay, let's start here. First, you read the requirement. They said that you should do what? The information below relates to Paradise Ltd. The financial year ended. Remember the date. Remember the date. Okay. So it ends when 29 February 2016. So let's do some workings. Let's start with the ordinary shares. As I said, we will read you everything. Let's start with our ordinary shares. Okay. Ordinary share capital. Well, we don't have anything written there. So let's see. Information. We check the information first. It says the Paradise Ltd is authorized to sell 5 million ordinary shares. It's just that they are authorized, but the thing is we only record those shares that are issued. I want to get my calculator. Only shares that are issued. So the shares that are issued the shares that are issued, it's your 3 million shares and your 1 million shares. See, so now they issued at the different prices. So your 3 million will, let's add up a slide here. Okay. Okay. Okay, that's your 3 million shares. Okay, issued shares. Okay. issued how many? 3 million. 3 million, which is 3 million shares, which is for 6 million. 2, 3, 1, 2, 3, of which 2 rand per share, isn't it? Then we continue. It says here 1 million new shares were issued on 1st December 2000. That is also in our this event occurred during our financial, and now the ones that were sold on market related value, on market value 4.5. So that is a higher value than this one. 1 million shares. That means we'll do this, and a further 1 million shares. Sold for 5 million, of which is 5 rand per share. So now I want us to calculate the average price per share. So what we're gonna do is, how many shares were issued altogether? It was 4 million shares. So what we're gonna do is, we're gonna say let me use a different color. Well, let's do it this one. 3 million. 3 million over the total 4 million shares that were issued. Okay. Then times 2 rand per share. Okay, let's calculate it. The answer is 1.5. Then what we do is we calculate also. You're not done calculating the average price per share. Okay. Then see 1 million over the total 4 million times the price per share that was sold. Isn't to calculate the average price for the ones that are sold? That is 5 rand. So we'll do this. Okay, then we'll add the 2. So when we add the 2, it will give us per share. Per Okay. All right. So we are not done. Let's continue with our lesson. Because they said something here also about the shares. 200,000 shares were repurchased on February 2016 from a shareholder who was relocating to another country. A payment of 770 was made on 20 February 2016. So I want to explain something before we continue. Remember, when we sell shares, what happens to our double entry principle? Remember, those shares that we're selling, they are a capital. So meaning that capital increase on the credit side when it comes to the T accounts, the ledger accounts. So under capital will increase with how much? 6 million. When we sell this share of 3 million shares for 6 million rand. So capital will increase by 6 million on the credit side, and on the debit side, what will happen? Our bank will increase also. Remember, our bank is an asset, so money goes in, the benefits are flowing in. That means our assets will increase. Okay, then same thing here. 1 million shares were sold, and on the 15th of December, what happened is our share capital equity also increases 5 million because of the sold by on the market price. So it will increase, and also our bank balance will increase. That means that equity will increase on the credit side, and our asset, which is our bank, will also increase on the debit side. So just remember that. So just to make you remember something, to remind you of something. Then 200 shares were purchased on the 20th of February 2016 from a shareholder. That means that there is an outflow of money going out, which means that bank will decrease by this amount, 770. It will decrease, you see. And then because of there is an outflow of money. So let's work out this one, because we've already worked out that one. So let's deal with this one. Let's finish. So this one, okay. So now you're still here. So now what happened is we have calculated the average price. So after calculating average price, they said how many shares purchased. It was 200 shares. Now calculating our share capital, we're going to use this average price. Okay, let me not go ahead of myself. 200 shares were sold. Let me not be fast. For 770. Is that so? Let's take it slow. 770. All right. They were sold for 72 to us, to the company, Yes, that means, what do you call it? A repurchase, ne? Repurchase of shares, in short. Okay. So now what we'll do is we'll 200 shares that were repurchased times what? The average price per share. That is your. Do you remember we did calculate it? Okay. then it will give us how much? I hope you've got your calculators with you. That is your 550. Okay. That is a 550. Meaning that all in all, okay, let me just use another color. The company issued how many shares? It's 3 million. The first 3 million plus 1 million minus 200. Sorry about that. 200. Okay, that will give you how many shares that were issued? That is 3.8 million. So let's see how much of a share capital do we have. So it will be your first 6 million plus the 5 million minus your 550,000. Okay, then your share capital, that is equals to I think it's 10,450,000. So we just wonder why. Maybe you're asking your question, what happened to maybe you should have used maybe 5 rand per share here. Oh my word. We should have used maybe 5 rand or 2 rand. Okay, so now we want to see where the profit, the other money went to. As in, because of they bought back the shares for, they didn't buy back the shares for this amount. They bought the shares for 750, not 550. So what happened is the additional one, it was an expense of repurchase. Okay, so what we'll do is we will say sorry, it was 770, not 750, 770 minus this 550. Let's see how much it is. That is 220. Okay, that is 220. So with this 220, what we will say is this 220 divided by 200 shares will give us 1.1 rand per share. That was the expenses, the funds that were used to buy back this. Okay, this shares. I hope you get this. And then let's go to our retained earnings quickly. Retained earnings. All right. Okay, with the retained earnings, we're given a figure here. I think we're given a figure. Here's a figure that I saw it. I know it's there. Provision for bad debt, fixed deposit is 90, and then the load. I think on the previous slide. There. Yes, that's where it is. Got it. That you retain earnings. It's already given, but it's a retained earnings net profit before it was accurately calculated to 3.8. That is that is your profit, net profit before tax. So we want to calculate the retained earnings. So we'll start putting this amount and calculate the 28%. Okay. So we'll say is 3.8 is 3,800,000. Okay, let's do this, because if I just write numbers, you might forget what are those numbers stand for. Let's see, let's just write the proper thing. Let's see, profit before tax. Profit before tax, that is your 3,800,000. Yes, so it's good to write in full. Then we've got your income tax, and that is your, it's 28%. So say 28% of 3 of 3,800,000. Remember, when it's like this, show it in bracket because it's an outflow, okay? All right. And also, remember, there's something here. There's something that this following 890. Okay, this is alone. Okay, this. That's what I'm looking for. This now. Oh my. This. Okay. The directors paid an interim dividend of 840 on 28 August 2015. A final dividend, okay, let's start with this one. They paid a dividend of 840. So when it's like that, it means that okay, an interim dividends, isn't it? Interim dividends. That is 4. That is how much? 840,000. And let's put it in bracket and see something here. The directors, okay, and the final dividend of 44 cents per share was declared. Okay, let's start with this one. Remember, 840, when directors pay dividends, what happened is it's an expense. That means that there will be an outflow from our assets, which is bank, so it will decrease on a credit side, and the expense of dividends paid in on what? On a debit side by 840. Let's move. Same thing here. So a final dividend of 44 cents per share was declared on 29 February 2006. Remember the date? It falls in our financial year. So all shares, including shares repurchased, you see, they said also including this one. Oh, so with my hand, including this one. Or maybe let me use a highlighter. So all shares, including the shares repurchased on 20 February, qualify for the final dividend. This one, yeah. That's these dividends will be paid on the 31st March 2016. Remember, it's an event has been declared. That means it has to be recognized. So it was declared here on the 29th of February, even if it could be paid in the next financial year. So we record it with 44. Okay. Right, wonderful. Okay, there we go. So it will be our final dividends. That is your 0.44 times, they said all the dividends, even the ones that were repurchased. So we won't say only the 3.8 million shares that qualify for the to be paid dividends, but all the shares that were issued, even the repurchased one, they also received dividends. So we'll say 4 million also times 4 million shares. Let's see what's the total. Okay. Let's see what's the total. 4 million shares. Okay. 1,760,000. All right, then you have to find the amount that will go to our retained earning. It will be the profit for the year. Remember that profit for the year normally goes to our retained earnings under our in the statement of financial position under equity. That will be our equity. So we'll say now we'll calculate 3.3,800,000. What minus 1,000,000 and 64,000 minus 840,000 minus 1,760,000 Okay, there we go. Okay, let me recalculate it. I think I missed that number. 3.8. 1, 2, 3. 1, 0, 6, 4. 1, 2, 3 minus 840. 1, 2, 3 minus 1, 7, 6, 0. Yes. 1, 2, 3. Yes. Review. There's 36. Yes. Oh. Also, the funds. We didn't include the funds. Wait, we are not done. We didn't include the funds. Sorry about that. Okay. Funds that for what's happening now? Repurchase of shares. Remember, we did calculate them. I think in these were the funds. It's the additional one. So what we will do is we'll say 1 rand 10 cents times 200,000 shares. That was our expenses. So we'll just do it right here. I'll just go right here. Yes. Review 200 then. 220. Yes, that's right. I hope I didn't forget anything. So I've got a little activity before we continue with our lesson. This one. Before we leave, we stop because we just resume, we just pause a bit and we'll continue with this question. We'll take it slow so that everyone should understand. Okay. So now I'm gonna connect everyone. Okay. Let's start this one. Remember yesterday, just to recap a bit, yesterday we did this one, and let's just do this quickly before we go. Say director. Those are what? Not the owners of the company, but they are appointed by the shareholders of the company. Okay, it's just an activity just to relax your mind, to remind you of the previously internal auditor Monitors what? Monitors control measurement to mismanagement and fraud, expresses an audit an opinion on the financial statements. No, that is this one. It matches with. Okay, shareholders. Do they monitor or are they owners of the company? But they are the owners. Okay, then the last one. This one, and here we go. Yes. So now that's it. So we'll just stop right here with our lesson. Then we just put a comma. We'll continue with those questions. We'll just get much questions as we can. Thanks. Have a good day.